Joining us now is Northlight Asset Management Chief Investment Officer Chris Zaccarelli. Chris, good to see you. You think this rally has legs? What is your outlook for the rest of the year and heading into the new year?
Yeah, we do think this rally has legs. We think we're going to finish the year very strongly. We think a lot of the trends that we've seen so far in terms of the economy continue to expand, opportunities for business around the world and also domestically. We think those trends will persist. However, as we look ahead to next year, we have to take a look at valuations. Right now, the S&P is around 21.3 times forward earnings. Historically, it's around 17. So valuations are higher than normal. We really are going to have to see either profit improvement in terms of profit margins going higher, or we're going to see revenue growth for next year. And we think the pro-growth policies that we expect in terms of deregulation, tax cuts, or at least preserving the existing tax levels could really provide some tailwinds for the market next year. We're not expecting it to be quite as large a gain in the S&P unless we see some real productivity gains. But we do expect another good year next year, and we think these pro-growth policies are what are going to push this market forward.
Yes, and as we look at the stock market, we also want to take into account the bond market and interest rates. Take a look at the 10-year Treasury yield this morning. A futures market is pricing in a 56% chance that the Federal Reserve will cut rates by 25 basis points at the December policy meeting. But Fed Chief Jay Powell's no hurry to cut mantra and his signaling of possible fewer cuts in 2025 could disappoint borrowers. No, Chris, what are your thoughts in terms of rates?
I think that's right in terms of interest rates. Prior to the election, we were expecting something like 5 or 6 rates through the end of this year and into next year. However, if we have those pro-growth policies and we see the economy doing better than expected, then there's less of a need to cut interest rates. So I think investors need to kind of temper some of their expectations. We think a more realistic outlook would be kind of 3 to 4 cuts. So I think it's about right for a 50-50. 50-50 chance in December, 50-50 chance in January. But looking over the end of this year and into next year, I think 3 to 4 cuts are a lot more reasonable to expect than 5 or 6. Because if the economy is doing a lot much better, you're going to see interest rates stay probably a little bit higher for longer because they don't need to cut as much in order to support the economy.
Yeah, John Lonsky, jump in here.
Well, let's not get ahead of ourselves as far as these potential rate cuts are concerned. I mean, my goodness, we still have a lot of asset price inflation. You could argue you have it with equities. You just hinted upon it when you talked about the very high PE ratio. And look at Bitcoin. My goodness, that's approaching $100,000. So there's a lot of excess liquidity sloshing around, and this asset price inflation might find itself leaking into the economy, where we see a revival of consumer price inflation, especially if these tax cuts and deregulation succeed at stimulating domestic spending.
What do you think, Chris?
No, I think those are all really good points, and that's our concern as well. We want to see inflation go back down to that 2% level. We've been on a pretty good trend. We've seen a lot of the excesses over the past few years start to come out of the market, but I think you want to see the Fed continue to reduce the size of their balance sheet. If they do cut interest rates, we want them to cut them less than they otherwise would have. And again, they should only be cutting because they think the current Fed funds rate is significantly above the rate of inflation. They have to be careful not to take those rates down too low, because I agree, taking rates down too low too quickly could provide the possibility of inflation to come back into the picture, and that's not something any of us want. One of the biggest things that we've had, the biggest problems we've had in the economy so far has been those higher prices. We all know that. We know that's a problem. And unfortunately, those prices aren't going to go lower. The best we can do is make sure that prices don't increase at a rapid pace. So anything that would, reignite inflation would be really bad for the economy. We really want to take all the good that we have there in terms of the economic growth, potentially deregulation. I think keeping the current tax rates at the current level, those are the things that are really good for the market. Whether or not interest rates should come down another 100, 200 basis points, we would disagree, but we think there is some room for cutting. It's going to be a balancing act. I agree, there's risks to both sides.
All right, we'll leave it there. Chris, always a pleasure. Thanks so much.
Thank you.
All right, Chris Zaccarelli joining us. Your morning